So, good morning, good afternoon, good evening. Thank you, folks, for joining us from across the world. This is our very first webinar of the year. Welcome to 2025, if we can still say that. I feel like it's been a busy one already. We've been busy cranking out the content for our readers, and we're glad that you're joining us here for a discussion of three major reports that we've recently released at Citeline Climate. So we're together for an hour here, and we're joined by an amazing group of our leaders from the team. So you recognize these faces already. No further introduction. We've got Kim, we've got Mark, we've got Julia, and I, Sophie, will be joining you as think of it as a radio talk show moderator host, hopping in and out as we cruise through this content. So we'll pull everybody up later, section by section, and then for a group discussion at the end on our hot takes and outlooks for where we think the year is going. Structurally, we're covering two major reports and then one set of survey results from our readers. So first, we're going to dig in with Kim into the real meat of it, the structure here of the climate capital stack. You know, we love that phrase. And so this is essentially, where is the money coming from? Where might the money be going? You can think of that as a leading indicator of what's to come in climate capitalization. All right, our second large report, which we put out right at the beginning of this year, looking back on what happened in 2024, is our kind of quintessential investment trends, right? So what happened? Where was the money deployed? Into what sectors? Into what geographies? Into what stages? And we're going to have Julia walk us through that. And then last, we're pulling everybody back up on stage, and Mark is walking us through a really fun piece, which is our oracle, looking into the future with the support of you all from our survey results. And also, we're turning the mic back to you with some polls, and we'll engage in the discussion there. And so, talking about polls, we're going to be asking you all to engage with us throughout these sections. So no sitting back and eating your lunch or having a coffee here. We're handing it over to you with some questions. So to warm us all up and make sure that we know how to click through, we're going to pull up our very first Zoom poll here. This is an easy one. This is a warm up. You all should be able to answer this. I see that we've already got 300 folks that are in joining us in the webinar today. So we hope that we're getting at least 300 responses. So click, click, click away. Question over to you is, how long have you been a subscriber or a reader to CTBC? Click on that and we'll see what comes up. We'll give you 5 more seconds here. I'd be super curious who's the longest reader. We love our OG readers. Even if you're a new reader, thank you for subscribing. All right, let's go ahead and wrap that one up with the magic on the back end here. What do our results look like? Long time followers since day one, 9% of you. I don't know if that's statistically possible, but thank you regardless. Recent caller, we love you too. Okay, can we kick out the what is CTBC people? Just kidding. Thank you folks for tuning in. Thanks for responding to the poll. Great, we got over 70+% participation in that. Awesome, looks like you know what you're doing. Let's get right on into this. All right, so over to Kim. She's gonna hop right up on video here to chat through this core first report, which, you know, we love this phrase, the climate capital stack. Kim, you wanna take it on away?
Awesome, thanks, Sophie. I love seeing the results of that poll. Got a couple of day ones in here, so good to see everyone. For the day ones who've been following along, we've been talking about the climate capital stack since the early days of the CTBC newsletter all the way to now, with a lot of the Citeline climate data driving the report. And so talking a bit about the why behind the report before we go into it, obviously the state of climate funds, the state of capital that's getting raised in climate is a really important leading indicator for what might happen in the future. It really dictates who might get funded down the line. And so in 2024, if you remember 3 big things that happened, one is we saw a strong close for climate AUM, despite the overall challenging fundraising market. Number 2, we saw dry powder stack up. We'll talk a bit more about what dry powder means and whether this is a good or a bad thing. And then 3, despite more AUM, despite dry powder stacking up, the scale gap or the missing middle or the valley of death, there's like 10 names now for it, is still real. So we'll talk a bit about that as well. And so starting with a strong 47 billion close in new AUM. 2024 saw the second highest year in climate AUM close. For those who don't know, AUM is assets under management, so amount of new funds raised to deploy towards climate, energy, sustainability. And this is a pretty interesting trend. We can see that in 2022, Q2 of 2022, there was this massive spike, right? It was really the high watermark for AUM raised for climate. And this was the period when a lot of the large mega funds, Brookfield, TPG, General Atlantic, et cetera, raised their first funds. Now, 2024 actually took second place, right? 2022, we saw 50 billion of new AUM. 2024, we saw 47 billion. And this was really driven by a lot of the mega funds coming back to market off of the success of their first fund. So Brookfield and TPG Rise Climate came back to market, have partially closed their second fund, making up 14 billion, so essentially 30% of the 2024 closed AUM alone. So that's definitely been a big macro driver of that new AUM number. Now, if we look at AUM at a cumulative level, we can see that there's been 164 billion total of new funds raised in climate since 2021. And it's really been this huge surge starting from that 2022 period. 31% came from 2022, 29% came from 2024. So again, lots of capital coming into the market. But if we switch that view and we look at it from a dry powder angle, now dry powder is defined as capital that's been raised and not yet deployed. So when an investor raises a fund, they typically have a few years to deploy that capital. And so we did some back of the envelope math here and looked at how much new funds have come into the market relative to how much has been deployed. And there's a couple interesting things to pinpoint here. So again, looking at that Q2 2022 peak, you can see that spike in new AUM in that teal color. And then you look at it against the backdrop of the big purple mountain, the big purple dry powder stack, right? And we can see that because of that Q2 2022 spike, there's been a big increase in dry powder, creating sort of this unprecedented cliff during that 22 period, where there's a lot of new funds, a lot of dry powder that just came into the market. And now over the past few quarters has started to get deployed. New funds still coming into the market, of course. We talked about that 2024 47 billion amount, but towards the end of the year, we started to see a bit of a plateau, a bit of a small dip in that dry powder mountain stack, which signals, it's not an infinite amount of dry powder out there anymore. That capital is starting to get deployed. We are seeing a trail off of that dry powder stack. And whether this is a good thing or a bad thing, I think is actually pretty nuanced. When you think about deployment, you do want to see that dry powder stack get spent up, right? We don't want a bunch of zombie funds that raise a ton of capital, but don't actually deploy that into climate solutions that can really mitigate the climate crisis. You do want to see it get spent. But at the same time, just like your bank account, you don't want to see it get spent too much. So for now, it seems like a relatively healthy trend of there's new funds coming into the market, it's getting spent. We're not yet seeing, a big dip on the fundraising market. But definitely, I think something to watch as the market shapes up. Now, zooming in closer to what's actually making up the shape of this dry powder stack. It's not just VCs anymore. So we talk a lot about the sophisticating climate capital stack, right? The fact that the capital stack is more than just venture, especially now with climate tech and clean tech being a theme that's not just technology, that's not just innovation, but is really starting to graduate out of the venture capital ecosystem. And so a big portion of that dry powder stack, 65% that we've tracked, is really infrastructure capital. And that's why it's such a high amount. It's a lot of infra funds who are stepping into climate, and also LPs, limited partners who invest in these funds, seeing infrastructure as a pretty safe and sustainable place to park their assets, especially to kind of weather the storm that we've been seeing over the last 4 years with a challenging macro environment. And so as we look at climate tech sectors like solar, wind, batteries, EVs starting to mature, that infrastructure play, betting on renewables, betting on transition is really starting to ramp up. Obviously, there's a lot of conversation now on AI and the load growth challenge, where there's going to have to be a lot more investment into power, into grid infrastructure. So again, a lot of tailwinds for infrastructure as a safe haven for some of those climate tech dollars. But I think interestingly here as well, as we're looking at the sophisticated climate capital stack, historically, infra has been a pretty mature asset class. But we are starting to see funds like Brookfield's transition fund, starting to take a bit of what they're calling, emerging transition risk. So half of part of their transition fund, not only going towards mature solar and wind, but also starting to look at sectors like sustainable aviation fuels. So last year, the transition fund announced up to 1.1 billion into Infinium, an eSAF producer, an e-sustainable aviation fuels producer, with an initial 200 million for Infinium and their initial project Roadrunner, but then up to 850 million for future projects. Obviously, this is tied to specific milestones, but a promising sign that with all these infrastructure capital dollars coming in, it's not just the mature stuff that could get funded. Some of the emerging sectors and tech could get funded as well. Now, zooming into what the early stage looks like. Yes, there's a lot of infrastructure capital coming in, but early stage funds, VCs in particular, have been starting to show signs of decline. So we put a lot of, careful attention to getting all these logos just right. But what this really shows is the early signs of a decrease in new funds in the venture space that are getting raised, facing a lot more of that music of the tougher fundraising environment. A 9% decline, I think definitely a tougher time, especially for first-time emerging managers to raise venture funds, LPs having higher standards around track, things like that. But also a sign of a maturing capital stack that we're now, year 5, year 6, and sort of this wave of climate tech. And a lot of the solutions we were looking at in the first year have now started to move on Series A, Series B, Series C into that maturing capital stack. So if we look at the other side of the capital stack, growth, private equity, infrastructure, those are continuing to climb. So pretty promising sign as we think about the sophisticating capital stack, the maturing capital stack, that when we first tracked the space in 2020 was mostly VCs. And now we're starting to see a lot more PE platforms, Apollo, BlackRock, et cetera, becoming pretty popular with LPs and starting to bias towards building a separate climate transition sustainability fund to play on this trend. And I think this has been, a pretty exciting signal towards the maturing capital stack. But despite all this, last year, we published a lot on the first of a kind challenge that despite infrastructure capital starting to come in to some of these earlier sectors, and despite, government funding and a lot of LPO dollars coming in, when we speak to companies, especially startups, they all are still facing this scale gap challenge that it's pretty challenging to go from a lab pilot, raise venture capital, to then building a first of a kind plant or project where you have to raise hundreds of millions, if not billions, to get that first commercial project off the ground. And it's still not that first of a kind, that scale gap challenge is still not the right risk return level for most infrastructure investors. And so seeing the capital stack get pretty creative here. So now I want to pivot over to ask you, the audience, questions. We want to really get this engagement going. And so speaking of the skill gap, we want to hear from you. We'll run this pretty fast, so get ready to hit the form. Let's get the form up. We want to hear from you. Will there be more funds filling the skill gap? Yes or no, pretty simple. And number 2, what unique funders will step into the skill gap? If so, philanthropic capital, corporates, banks, governments, infrastructure funds, or no one, if you thought number one was no. So let's get those survey answers going. We're going to close it in a few seconds here to keep it rolling, but very curious to see what everyone thinks about what scale gap looks like in 2025.
Let's go. And we've got over 400 folks that are joining us now on the webinar. So thank you for tuning in from around the world. Let's get at least 400 responses up here in the poll. Unfortunately, Kim and I cannot vote here, but I think we know where our responses would be. Fantastic. We'll give that 5 more seconds or so. Pop that one in. Drum roll. Wow.
All right, pretty positive. I do think we have very positive, uh, typically a positive audience. So yes, 70% more funds filling the scale gap.
Dang.
Pretty.
That Kim, I don't know about you. That's maybe I'm getting pessimistic here, but that is a very optimistic take. I'm confused. That's fantastic. I mean, I'd be curious. It depends on what type of capital, right? Like folks hope or
Yeah.
think or expect will be filling that scale gap. So I suppose that's our second question, right? So
Yeah,
pretty even
which
split,
is a pretty,
huh?
yeah, even split between philanthropic kind of taking the lead, corporates matching that, infra funds third, government's 12%. I wonder if a year or two ago that would have been a different percentage. But yeah, interesting to kind of see how that stacked up. It's actually a little surprising to me how I think low government scored. I think philanthropic capital seems to be, and catalytic capital seem to be an funder that a lot of folks are turning to, although kind of a question how much, capital is actually there.
Certainly, right? I think the depth of that category isn't won't bridge us all the way, but hopefully that's where the focus of that capital sits. I mean, look, the difference between the philanthropic, the corporates, and the infant funds, the outcomes and the expectations and the rationale for that are all wildly different. So neat
Yeah.
that y'all think that everybody might have a role to play there. So, all right, we're tracking nicely. So we'll go ahead and close that poll on out. Thank you, Cam. And we're hopping on in to our second large report. And so we kind of looked at structurally a bit of where are we going and like how, right? What are the funders that are going to get us there and the structures behind it. And now Julia's hopping in, having cranked all of the data from what the heck happened last year, and she'll talk us through these investment trends. So hi, Julia. Thank you. And right on over to you.
Hey, Sophie, thank you. Well, Kim laid out where all the money was coming from for you, and now I'm going to talk about how it was spent. So Kim and Mark asked me to drill down into 3 things for you to remember. It was tough. There's a lot in this report, but the 3 that I want you to remember are first, this is the new normal. Welcome, everyone. This is kind of what we can expect from now on. The second is energy overtaking transport as the vertical with the most investment in 2024. And the last one is around more exits and more consolidation. That was a pretty big change from last year, and we're going to dive into it. But first, let's take a look at this new normal. So we're showing you a cumulative chart, and of course, it's climbing. But if we look year on year, investment in 2024 was actually down 14% compared to 2023. The reason we're not saying, oh, it's a downward slide, rather it's new normal leveling out, is that that was a lot less than the drop from 22 to 23. That was 24%. So if you look at this curve, it's starting to look a lot more linear rather than the exponential that we're used to seeing in climate tech when you think about solar and wind capacity. For verticals, the transport is still the largest fraction there of cumulative funding, but there are some signs that that might be starting to change. And that's what these vertical charts are really showing. So the big story here that got picked up a lot in the news was that energy has taken the crown from transportation for the first time since 2020. So if you look across the last bar in each of these stages, energy is actually the top one at 9.4 billion. I would love to say that this is a triumphant story of energy doing incredibly well and clean firm power leading the charge, getting back to our climate tech basics. But really, this is much more of a story about resiliency in energy funding and a huge drop in transportation. If we actually look at the numbers and exclude transportation, then funding was pretty much the same between 23 and 24. So transport is really where that big drop is coming from. So energy was up, so was built environment. That's really around a lot of enthusiasm around investing in sustainable data centers. Everything else pretty much down or even. So if transport and energy are the two headlines, let's dive in a little deeper into them and look at a few key sectors that I want to highlight. There are some super interesting new sectors within transportation, like low carbon fuels and aviation, but they're not big enough yet to make up for the massive drop that we saw in batteries. Batteries was really driving a lot of transport investment over the past few years, and it dropped from around 6 billion in 2023 to just over 1 billion in 24. So that's where this huge drop is coming from. Now, as transport is going down, energy is going up. And that was really driven by nuclear and energy storage. Nuclear funding almost doubled, and then geothermal funding almost tripled. So you have a lot of fans of clean firm power out there. Now, clean firm power is a trend that clearly isn't going away, but there's some super interesting stuff in our top 10 deals that I want to flag to you. And that is that data centers are kind of becoming the new darling for this sector. So the top deal there is IM Motors. That's a Chinese EV manufacturer. That was a Series B round, a 1.1 billion Series B round. So there's a sub-story here of how China could potentially start to change the landscape of what we expect from VC. But the two deals below that, Crusoe Energy Systems and Scala Data Centers, these are both data center techs, and they're about providing clean firm power to data centers. Obviously, these two trends are linked. You have a lot of interest in clean firm power from the hyperscalers, and so you also have a lot of interest in the companies that are looking at doing that. The rest of this, it's still a lot of clean firm. X-Energy is a nuclear company, Forum Energy does LDES, and then you have a few transport companies and Stegra, formerly H2 Green Steel. So some of the usual suspects, but some really cool trends there in data centers and the built environment rising. This leads us on pretty nicely to what was happening in terms of stage. The big changes were in Series B, which was up by a lot, and growth, which was down by a lot. The Series B, I'm not going to dwell on too much because that was almost entirely driven by that IM Motors deal that I flagged on the last slide. Without that, it would have been kind of even, just like Seed Series A. The growth is a really interesting story. Some of this is the big sectors that drove a lot of the growth investment, moving on to more mature stages of funding. So autos are probably looking for project finance. Wind and solar are getting some of those infra funds that Kim was talking about earlier. But there's also a lot more blended finance here. So a lot of the big deals, they're not just growth VC funding anymore. 12 is a great example of that. 200 million Series C, 400 million in project finance, and then $45 million in debt to fund its Moses Lake plant. Maybe if we'd been back in 2022, all of that would have been growth funding. So there's a lot of nuance here in these changes. One of the bright spots, though, is around graduation rates, because we think that they've really turned a corner in that they're rising again, but let's not get too excited because they're still lower than the 2022 highs of 33%. So investors are still being more choosy, and there are lots of zombie companies out there that got investment in 21 and 22 that maybe weren't as solid as they looked, and now they're trying to figure out what to do. But it is good to see that trend going up. We've talked a bunch about investors' flight to quality, and these graduation rates going up is a sign that there are some great companies out there with a path to profitability, with customers, with offtake agreements, and investors are finding more and more of them. I promised some more talk about exits because this was a pretty staggering chart this year. So exits blew past 2022's record. There were more acquisitions in 2024 than total exits in any other year, but very few of them actually had disclosed dollar amounts. It was about 90% undisclosed. So we think a lot of these were tuck-in acquisitions or companies that already had a relationship, just taking a majority stake. So exits are really the thing that's going to make or break this market. And they've already kind of started to break it. LPs need that liquidity, and they haven't really had any of it. So we need to think about there being a lot more market consolidation and about where that is really going to come from. But if I drill down into some of the specific acquisitions and IPOs that we found interesting, there are some trends here. In the acquisitions, these may seem like very different deals. You've got a CCS developer, a renewables developer, Ayana and ONGC and NTPC was in India, SLB and Aker Carbon Capture, Europe and US-based companies. But really the reason why these companies got bought was for their projects. SLB was interested in Aker Carbon Capture's CCS technology and their project pipeline. ONGC is the oil and gas company in India, and NTPC is a renewables developer. So they were really looking at Ayana's profile, portfolio and saying, that looks good, we'll buy it. On the IPOs, it was kind of the India story continuing, because two of these deals, Ola Electric and Premier Energies, these were kind of veteran micromobility and solar module manufacturers in India. That market is developing a lot. There's a lot of talk in India about how cheap renewable power is, a lot of enthusiasm around electrification to deal with pollution in transport. And so we think it's a really interesting market. And then the last IPO there is another story about data centers. So this was a SPAC that was done with Sam Altman coming in and saying, I think AI is going to need a lot of clean firm power, and I think that's going to have to come from nuclear. So this is a small modular reactor. I've told you about the exits that we think are really interesting. So now we want to pass it over to you and ask you a couple of questions. The first one is about how optimistic are you about exits in 2025? Do you think things are hunky-dory? More IPOs, more acquisitions, fewer bankruptcies? More like same, new normal and exits too, lots of undisclosed acquisitions, more consolidation, similar bankruptcies? Or do you think it's going to be a bumpy ride in 2025 with even fewer IPOs and rising bankruptcies? This is how you can tell I was allowed to write my own poll question. Not sure anyone says hunky-dory anymore. The second question is about which sector is going to break out in 2025. And we've tried to give you as much choice as we can. So scroll down so that you can see all of the options. So if you can't see your favorite sector, keep scrolling, or drop an other in there. I'm not going to read these all out. Take a look at the list, give us your gut reaction, and let's see what you think. I think that should probably give us all enough time to give our reactions. So let's take a look at the results. A lot of people on board with our
Not
new
so
normal,
hunky-dory.
Sophie. Yeah,
Not so
sad.
hunky-dory. Interesting.
Oh, a lot of love for energy efficient data centers though. People scrolled. People went all the way to the bottom to find data centers.
Yeah. I'm not surprised by that. I think my question is, are those startups, or are those essentially large
Yeah,
legacy
there's a
operators and businesses that are reinvesting into that?
Yeah, there's a lot of people talking about it as a safer place to put some money. So I wouldn't be surprised. But nice to see nuclear and geothermal up there, and grid tech making a resurgence.
Nuclear, man. That's so wild, just from a psychological perspective of the crazy shift, right, over the past 12, maybe 18 months. There's no way that would have been
Yeah.
26% not too long ago.
Yeah.
So,
It's amazing.
nuts.
Even just the visceral reaction of some of these names, 3 Mile Island. It's very interesting.
Yeah. On question number one of the optimism, maybe hunky-dory was a little bit of a misnomer, right? But I think I would have probably smashed that one. Not because I think that we're set up for any particularly massive IPOs, but because I think that we're just going to have more small to small mergers as folks come up against the reality that perhaps their business isn't going to go all of the way, and so they end up doing more of the undisclosed acquisitions.
Yeah, so still a
I
buyer's
just think there'll be a
market.
high percentage of that. Yeah, certainly. Yeah. Or folks that were able to raise a ton of money, but perhaps their underlying tech could be better, and they're smaller, strong underlying tech businesses, and they need to go team up with those more commercial teams. Neat.
Yeah, exactly.
All right. Julia, thanks. We covered an awful lot there. Brilliant. All righty. Julia, we'll see you in a little. Oh, you're staying. We're all staying back on. Fantastic. This is the fun section, my favorite section. Mark, you get to do the honors here. And I will hand my virtual moderator baton on over to you. And I think I get to hop into throwing out some hot takes with Kim and Julia.
Exactly. We're going to transition Sophie to panelist mode here because I want to hear all the hot takes. This section here, I mean, we've got some time. So what we're going to do is do a few things. The first thing is we're going to do sort of a recap of what we thought was going to happen in 24. The next is we had this report that came out, I think it was last week, or week before, that we called the Oracle report that Sophie mentioned at the top. We're going to go through sort of the trends or results from that, just to what the outlook that y'all thought is going to happen in 25. But like, guess what? A lot has happened in the past week, 2 weeks, that the outlook might have changed since we put that survey out. So what we're going to do is go through as a panel some of the questions we had, the questions that we put in the report, and just talk about those and put in some hot takes. I used to call these tie over the shoulder, sort of discussions where, this is off the record, but it's very much on the record because we're recording this thing. Okay. But the first thing we're going to do is go through the 2024 outlook. When you do a prediction, you always want to look back, see how you did, see if you did well. In 24, we thought the first thing that was going to happen was going to be survival of the fittest. That there was froth in 22, 23, et cetera, and that we'd see some churn, right? But the good companies would survive. Next, we thought we'd see the sophisticating climate capital stack, meaning it's not just VC, anymore, but we would see more and different types of capital come into the market to get these companies and projects moving. The next, we thought we would see the end of wait and see. That 23, that was our big takeaway, that it was wait and see, that people were just waiting and seeing what was going to happen before they made their big moves. We thought that would end and people would get in the game. And finally, we thought 24 would be the year of energy. Okay, so how did we do? Survival of the fittest? Yeah, I think it's a good call. Sophisticating climate capital stack? Absolutely. We started to see debt come into these markets a bit more. We started to see grants. More grants. We started to see, different and more creative types of capital to get companies and projects moving across the line. The end of wait and see, no, we missed it. We totally missed it. And that's fine. You got to be honest, right? That everybody was waiting to see what was happening in the US election, with CBAM, with EU ETS, those restrictions tightening, et cetera, et cetera. And so we think there's still a bit more wait and see going on. Was it the year of energy? Absolutely, as Julia mentioned. Okay, but for 2025, from the Oracle survey, we did a couple things. We put in a bunch of questions, and you can go look at the report and see the answers to the questions. But the trends that really came out of that are really kind of three. The first is that everybody thought it would be kind of a wave of consolidation. And consolidation can take a few forms, right? Ultimately, it just means that there's going to be fewer companies in a market, where the power and the activity is concentrated, right? And that can come from acquisitions, it can come from bankruptcies, it can come from, et cetera, et cetera. And so everybody kind of thought that was going to see more of that in 25. The next is that people thought it would be a retreat to safe harbors, meaning that more mature capital would go for more mature sectors like wind, solar, batteries, et cetera. But also, define safe harbors. Is it safe to build wind in the US right now, today? I don't know. We can talk about that. The list goes on. I'm sorry to editorialize, but I was in Cornwall in the UK this past summer, just driving through this tiny village, and I saw this giant sign that said, "No new geothermal power plant," in this middle of kind of nowhere village, hamlet. And what that says is define safe harbor. So everything is difficult to build, but nothing is going to be as safe as you might think, but some things might work. I don't know. We could talk about that too. And finally, the thing everybody's been talking about is the convergence of AI and climate. This results in the increase in energy demand, the chat about efficiency at data centers, et cetera, et cetera. And also we can talk about that too. But what we're going to do now is open up the panel. So everybody's going to come off mute. And we're going to go through a few slides as questions to see your responses, from the survey, but also throw in a few hot takes of our own. We're treating this much like a podcast, radio show, whatever, and we've got a bit of time to ease into it. So here we go. The first question is, will exits increase or decrease? It was roughly split. 60-40 is not monumental, but more people thought exits would increase. I'll open it up to the panel. Does anybody have a view on this for 25?
I'll jump in.
Optimists in our surveying. We've got optimists in the poll from with Julia earlier. I like to see it.
Mhm.
Maybe you kind of have to be an optimist in investing, or it's the psychological thing of if we all think numbers going up, then maybe it does go up. But Kim, you probably got a more sophisticated take on it.
No, I was just gonna say it's manifesting what we want. We also saw everyone say we expect to see a rise in investment last year. So it might not always be right, but I think there is some nuance here, right? Like we saw in 2024, that actually took me by surprise how many count of exits there were. But then when you
Yeah.
really dug into the numbers, like Julia said, and it's a more nuanced story, right? 90% plus of that were acquisitions, tuck-in, really more of a signal of market consolidation than it was of like really good outcomes. And that feels like the part of the cycle we're in right now, where when we first started sort of writing and tracking this space, 2019, 2020, it was kind of the start of it all. That was when there's a lot of venture. There was starting to be venture investors coming in, starting to be more startups, more sectors across, the climate tech taxonomy. And now a lot of those companies are reaching that make or break point, right? Who's going to sort of stay in the race, make it all the way to the public markets, who's starting to leave the race, whether that be exiting, filing for bankruptcy, as some have, or whether that be finding a longer term home, partnering with someone that could help take the tech, the projects to the next level. And it feels like we're going to see a lot more of that consolidation in the next year.
Mhm.
Yeah, I think the question here that follows after is which sectors are going to be the big ones here. And I think you'll see a lot of it in some of the places where we're kind of expecting a downturn. So potentially things like hydrogen, there's really cool tech there that could be snapped up pretty cheaply.
Oh man, Julia teed up the next slide all too well, but I'm going to comment on something first. That I totally think there's going to be more exits this year, and it's to what Kim was saying is like, why do you buy a company, in this space? It's because there's a trend you're spotting, and there's a tech or a call it project portfolio that you might be interested in having, right? And so a lot of the startups in a lot of these spaces have been buying up, leases and building tech. And if I'm a corporate thinking, you know what, I want to join this this AI energy demand game a bit more than I have been, I can buy a company to get access to the tech or the leases, right? And get a head start. But in terms of manifesting, go ahead. Yeah, please.
Oh no, I just had another point on this
Hit
one
it.
before we go to the next. I actually really liked your point on this like roll up consolidation concept, because from speaking to people in the market, right, I think there's a lot of consolidation happening, not just from a company to company standpoint, but also from a PE consolidation standpoint,
Yeah.
that we're probably going to start to see, companies,
Mhm.
they raise at high valuations, they raise a lot of funding. That market of private investment isn't as big as it was before. So there's a really, if you're a buyer, if you're a corporate buyer, if you're a PE, is an interesting sort of roll up opportunity right now to consolidate different technologies, perhaps across the carbon capture space, have a diversified portfolio there, or roll up, energy data plays. So it feels like that sort of roll up consolidation, both on the strategic side, but potentially also on the PE side, especially looking at that dry powder stack.
Yeah, I mean we talk about exits, and like exits are golden, right? Like we all need exits. And when we talk about that, we're often thinking from the who put the money into the funds that then wants money back from a kind of DPI or distributions on paid in capital kind of perspective. But exits are not all created equal. And so we've said, hey, actually more exits doesn't actually even mean more DPI. And then we've talked about at least 3 different kind of strategic types of exits here. And founders, look, if I could get a tattoo, I mean, I suppose I could. I should get a tattoo of the climate capital stack on my head because of how much that we say this at this point. But it's like you're running different strategies, right? So perhaps if you and you're acquiring for different reasons, or you're rolling up for different reasons. So PE folks, obviously, that's like we want a nice, neat, cash flowing, nice margins type of business. There, I don't see a whole lot of those. At least that's traditionally not how a venture-backed business kind of initially sets out to scale. But we're seeing some more folks pivot more into almost like clever services businesses, which I think are fantastic. And that maybe aligns a little bit more with a PE style roll-up. Then you're seeing tech disruptors who are a threat or open up a new kind of market opportunity to some of the bigger companies that want to move into net new markets or want to shore up their position and like almost acqui-hire and bring in that clever like IP and those clever kind of engineers. And then got another piece, which is, let's be real, like there's a lot of overlapping companies that have been venture backed to differing degrees over the past few years. And those folks are jockeying for kind of a same position in the market. And it's very unlikely that, these are sometimes these are more like winner take all types of spaces. And some folks are like 10 to 20x more capitalized than the other players. And sometimes those less capitalized players actually have the superior technology. And so my strong prediction is that we're going to see a lot of those companies smushing together. Whether you can actually do that kind of PMO and integration and culturally whether that works, or whether the VCs want that, or they'd rather like, shoot big and then hit a zero. I think culturally, 3 different strategies. Exits are not all created equal.
Okay. Exits are not all created equal, but also I think the takeaway there is Sophie's getting a climate capital stack forehead tattoo. Is that right?
Yeah,
Okay.
400 people have seen her say it.
Oh my gosh.
It's
On
happening.
record. Okay. So I thought we had time to settle into all this, but guess what? Time's getting away from us. I'm starting to get really conscious of time. So we're going to buzz through. This one, in terms of manifesting or what people are thinking, the downturn, kind of an overwhelming majority, I don't know, thought hydrogen would be the one that wasn't going to make it this year or the hardest hit in 25. Any comments here from the team?
I think it's whiplash. I think it was way overhyped. This is a recorrection. Hydrogen has an important role to play as a chemical input and fuel source. I think it's going to find its place.
Love it. Okay. In interest of time, we're going to move on to the next one and say which ones. Click to the next slide. Yeah, what will energy demand look like in 25? So there's all this buzz, around data center and the energy demand, that stem from that. And then how much of that could come from battery installation. So there's kind of a mix of opinion on this. So most people, 80%, said that energy demand would increase from data centers, excuse me. But then, how much of this would come from batteries? A little bit more mixed. I tend to be in the 80% group, but what does the crowd think, or what does the group think on this one?
I feel like
I
it's
think
pretty
there's
safe.
Yeah,
Pretty
I
safe?
think there's definitely going to be an increase in energy demand in 2025, but I do think there's this sentiment of, oh my goodness, like there's a lot of exaggeration. Speaking of whiplash, right? There's a lot of exaggeration right now of we're screwed, the grid can't support all of this, load growth coming online. Everyone and their mom is developing a data center. I mean, we saw that like 500 or 600 billion announcement on AI infrastructure announced 2 days ago. So yeah, there's a lot of hype. There's a lot of, data center development excitement, but at the same time, the energy equation, there's 2 sides to it, right? There's the supply side and there's the demand side. And yes, there's going to be a lot more demand for data centers, a lot more demand for AI, but at the same time, that demand side can flex. Whether you think about it from an efficiency standpoint, right? Can chips become more efficient, where it's not necessarily a linear equation of more data centers equals 1-to-1 more power needed to supply it. And then the other piece of that equation is this load can be flexible as well, right? So for actually training AI that doesn't necessarily need to be 24/7. So there's, I think, a lot of interesting and creative business models on pairing data centers, especially ones that are used to train AI, with more intermittent sources of power. But lo and behold, we don't have enough clean firm power to really support this data center build out. And folks are probably thinking about CERAWeek and some of these conferences coming up, and a lot of the conversations there are going to be about natural gas, are going to be about firm power, right? Sources of firm power that exist today.
That's teeing up the next slide. Speaking of timing, but actually, why don't we just go ahead and do that? Julie and I were talking offline about another sector not mentioned here. I won't put the cat in the bag for that one, but I'll let her do that. But we were talking about what sectors could break out. The crowd thought it was nuclear and geothermal for 2025. I tend to agree with that. My first hot take is I think we're going to hear a big announcement this year from an inbound player into the geothermal sector. That it's a way to get clean, firm power for these data centers. There is more and more next-gen geothermal that is sort of being proven out, but it's all startups that are doing it right now for the most part. I think 25 we'll start to hear a big announcement of a company saying, you know what, this is a big guy's game, big kid's game. We're going to get in and do this. My other take is on what the buzzword this year is what do you call it? Blue electrons. Meaning that if the answer to energy policy in the US tends to be, or is actually going to be drill, baby, drill, then that's going to do, what it does to oil and gas prices. It's going to drop gas prices. And what do you do when gas prices are low? You build electricity, build power plants with it. And why not take advantage of the tax credits that come along with, carbon capture. And so you do kind of a win-win there for that sector. So I think we could see more and more carbon capture, carbon removal in 25 along with geothermal. Those are my hot takes, but I'll pass it to the group.
Yeah.
So
I
help me
think
understand
that-
the blue electron. Why is it colored that way? These colors throw me off every time. That's electricity that then has carbon capture on the back end of it.
It's gas-fired power with CCS. That's what it is.
Yeah.
And it's basically just the same as, blue hydrogen, right? That whole
Fair.
color scheme. But the buzzword of 25. I didn't make it up, but that's the word on the street.
Makes sense. Like it's the big players, right? Benefiting from incentives. Makes a lot of sense. And if I get my Capstack tattoo, you need your nuclear bull tattoo, I think. So, or sorry, your geothermal.
I think it's geothermal.
Bull
Yeah,
tattoo.
sorry. Yeah. I mean, and I've been
form
around
of drill, baby drill.
Totally. And I've been around geo since 07, right? When I started off, and it's never been like this. Like you heard it here first, folks. Like this time's different. That there have been like rumblings of geo, like expanding and having a flurry of activity, but this time is genuinely different because the technology has gone through a step change. The interest, the demand for clean, firm, or baseload power has also gone through a step change. So yeah, my hottest of hot takes, oh man, no pun intended, is that it's this time is different for geo. Yeah.
Wow. Well, I'm not committing to getting any tattoos. Definitely not. But I will say that the thing that I am lightly bullish on that isn't here is around biomass. I've had a lot of conversations about that. It's been a pariah in climate for a long time because it's so difficult to do a huge biomass plant sustainably. But I have seen some proposals for small plants sized to a waste source. We've seen another set of huge wildfires. There's a big conversation about forest management in the US, in Canada, and many different places. I think there will be more sources of sustainable biomass. And if you can size it, the economics could pencil out. It could be something that those data centers think about doing on site.
I suppose not wildly different than kind of most modular. If we look back at the big deals, right? It's a waste energy source, often in that case, kind of natural gas or flared methane, right? Being converted, modularized, and then used for things like compute and then for data center powering. So So perhaps, yeah, interesting. I agree. It's been very pariah. Maybe you should brand it, Julia. You know, like we've got Thrill Baby Drill, we've got Mark and his hot rocks. Like we need a, I don't know, Hot Baby Chop or something for us. I'll work on that one. Oh man, my take here is, I mean, you just brought up fire, right, Julia? I'm like, you can't be in the US or many places in the world right now and not think about the immediate impacts of the reality that we're,
Yeah.
whether we chose this implicitly or explicitly, we're operating in a different world in a different scenario, right? So remember back when climate tech was more like tech that was trying to solve the climate, and then we kind of operated in this mitigation and efficiency realm for quite some time. And I'd argue that many of the sectors that are on the page kind of skew more towards that orientation. I like to look to invest kind of first capital into many of these businesses, and the founders that we get to engage with are those that are thinking for the next kind of 5 to 10, 15 years out. And a majority of those folks are pitching in the broader bucket of just the world is going to be weirder and wackier and frankly often more dangerous. And so in those scenarios, you know, that's resilience and adaptation technologies heyday, whether we like it or not. And so I would expect to have seen some more insurance plays, some more kind of clever financing plays, some more hardware plays, right? And then some of the enablers to that. So perhaps some additional kind of capital markets pieces, or some additional kind of how do we get more capacity out of the assets that we've already got. So I'm thinking a lot about those sectors, which I also think probably need a bit of a rebrand, right? Like resiliency and adaptation just sounds so terrible and negative. I'd love to come up with
Definitely.
something that sounds a little bit, you know, more we all come together for a new reality.
And this is something we've talked a lot about, both at Sightline and CTVC, right? Thinking about this, how do we frame climate adaptation? What is like the framework for adaptation, especially thinking about it from an investment point of view, right? I think it's obviously something that we're all thinking about from a climate solutions and policy standpoint, but are there tangible solutions within the adaptation, resilience sort of ecosystem? And I think, you know, I don't think 2025 will be the year of this necessarily, but I do think we're starting to hear a lot more about climate intervention, geoengineering. Maybe it's more of a 2030, 2040 year of, hopefully not. But I do think the conversation around the research, understanding what that looks like, what the potential impacts of that are, is we're starting to hear whispers of that. My vote on what 2025 will be the year of, this is kind of a cheat because it's not here on the survey. I think it'll be the year of getting back to basics. We talked about the new normal and investment trends, right? That 2022, 21, we saw this like big spike in funding and SPACs and excitement and hype, which is great. But it feels like 2025 broadly will be the year of going back to basics, that investors and companies alike are kind of going to gravitate back towards their comfort zones and more mature sectors, but also that there is a pretty interesting opportunity in these incremental transition strategies, right? I think grid tech is a great example of this, where used to be an investor at EIP back in the day. You talk about grid tech, everyone starts to tune you out. That's becoming popular again, and not just the cool like AI stuff. That's great, but even the boring stuff, right? Think like transistors, think conductors, like a lot of the stuff that kind of keeps the electrons and the grid humming is coming back. And also incremental things like energy data and analytics, software and services, construction for the grid, for solar, for wind. So a lot of these like getting back to basics feels like there's 2025 could be the year of as well.
There's probably even an AI meets getting back to basics too, right? Of like, how can AI help us solve the complicated computational problems that AI driven, demand is bringing to the grid. So bringing it all back around. Cool. Mark, you were going to drive us forward here.
Yeah, we got to wrap. We need a couple minutes for Kim to wrap us up, but I think we should land on this really quick. So Kim, you had a point on this that you wanted to make, that the world is big, all that stuff. But let's make that point, and then we have one more poll question, and then we'll pass back to Kim to wrap.
Yeah, real quick. I mean, the poll question is going to kind of hint at this and get everyone's take here as well. Obviously, lots happening in geopolitics today, which we won't get into, but I see a lot of opportunity beyond just the US, especially looking to Europe and the Middle East. There's kind of this question now being in Europe, are they going to step up to the plate? But the Middle East, even though it's not colored in here, is increasingly becoming sort of a focal point for the broader transition, led by Dubai hosting COP. A lot of funding, a lot of dollars in the Middle East. I think they also understand that the transition's underway and they're going to have to be a part of that. So it feels like increasingly there's going to be a lot of attention paid there.
On that, there's two more questions for the poll, and I think Kim just made her pitch on question 2, but answer it how you will. If you disagree, if you agree, I would love to hear your answers. So the first is, how will Trump's return impact climate tech? What will be the Trump pact of this all? And then, if the US pulls back, which country or region is most likely to step up on climate tech?
Don't let my take bias you. Everyone else choose a different answer.
Okay, we'll end it in 3, 2, 1. Okay. It's gonna be about 4 years. There's where the pessimism comes out. All right. 28%, no real impact. Okay, things are going, and could be a net positive. Okay,
10%. That's pretty good, I guess, for it being a net positive.
Definitely not nothing. Okay, the sleeper. Kim, I'm not sure the crowd agreed with you on Middle East, but I tend to. I think it's a sleeper. Europe, interesting, but again, just like Clean Tech 1.0, that China could be the thing we're not necessarily collectively paying enough attention to, and it could come out and be big.
Totally.
It's in their own game anyway, right? It's not necessarily even like looking to what the US is doing. They've got their priorities pretty cleverly and clearly laid out. So it's more US leaving open additional space on the field.
Absolutely. Okay. That is the hot take segment of the show. I'm going to pass it to Kim to wrap us up and close.
Awesome.
Right.
Thanks so much, Mark, Sophie, Julia. Really appreciated everyone's hot takes and also volunteering to get tattoos. We'll hold you all accountable for that. But most of all, thank you so much, all 400 of you, for tuning in to the very end. Really, really incredible. Also, see a lot of questions, see a lot of chitter chatter in the chat. Sorry we didn't have enough time to get to all those, but really, we would love to hear all of your hot takes. I'm sure all of your hot takes are even hotter than our hot takes. So 2 quick housekeeping things on our side. One is this webinar, this recording, we're going to have it actually live on YouTube. So afterwards, if you've joined, we're going to send you an email with the link to the YouTube recording. So you get to watch all of our hot takes all over again. And Josh in the chat should be sharing over the links to all 3 of those reports, the capital stack, the investment trends, and the Oracle, looking back, looking forwards. And then the second point is, for those of you who are Sightline clients, everything we talked about, the data, the reports, all of it is live updating, as you know, on the Sightline platform. If you're interested in what being a Sightline client looks like and how to leverage our data, our insights, and also just talk to all of us here on the panel more, shoot us a note at hello@sightlineclimate.com. We're always happy to chat. And if you also have hot takes that we didn't get to or questions we didn't get to, shoot us a note at hello@sightlineclimate.com. We'll really try to get to everything. We have people monitoring that inbox, so please, please, please reply, respond to us. We'd love to hear your takes. Thank you again for everything. I hope you all have a great Thursday and start the 2025 year off on a good note.